ladies and gentlemen. Thank you all for joining us today. Very glad that you could all tune into our jointly organized webinar by Fintech News Malaysia and also Kenanga Group as well. Today, we'll be discussing what 2021 holds for the future of investing and wealth tech in Malaysia, which is a timely subject given how much the world has changed in the recent months. If someone fell into a coma in February and woke up today, he or she would be very confused about what's going on in the world with how the pandemic has changed our lives and how it's fast-tracked digital adoption across various verticals. Now, joining us today to peer into the crystal ball, we have on the very top Sam Shafie, who is the CEO of pitchIN. pitchIN is the largest equity crowdfunding platform in Malaysia. And below him, we have Wong Kaming. Wong Kaming is the CEO of Funding Societies. And Funding Societies is the largest P2P financing platform in Southeast Asia. Below him, we have Ken Yew, who is the head of AI and Quant for Kenanga. Kenanga is the largest independent investment bank in Malaysia. And below him, we have Tang, who is the country manager for Luno. Luno is the first crypto exchange to be regulated in Malaysia. Gentlemen, welcome to the show. Thank you for joining us.
Thanks for having us.
Yeah. All right, great to have you all. Okay, so why don't we start by painting a broad picture about what's happening in the wealth and investment space. So maybe we can start with Ken, and Ken can give us what's happening broadly across the investment space in Malaysia and Wealthtech, and then we can zoom into the respective panelists to kind of share about their specific vertical, what is happening and what is to be expected. Why don't we start with Ken? Ken, you have the floor. Feel free to share your thoughts with us.
Okay. Okay, hi, morning. I think while fintech and AI development are still in a very early stage in Malaysia, but it is believed that the trend of fintech and AI developments is unstoppable, in my view, and could be further on its way to become the mainstream in the financial services sector in the long run. This is because the development of fintech and AI adoption have been growing very rapidly. Now, for instance, according to a survey conducted by Cambridge Center for Alternative Finance in 2020, 85% of all respondents in the study use some form of AI, with fintech companies being slightly ahead of other incumbents in the AI adoptions. And according to another market researcher, he also estimated that the global AI in fintech market actually already, I think, achieved about nearly $7 billion in 2019, and it's expected to grow to beyond 20 billion by 2025. That translating into a CAGR of about close to 25% over this 5 forecasted year. So with that exciting growth rate, I think that will actually bring that development nearer to our home country. In terms of trading, for instance, let's say we look at some example from the overseas country, like in India, for instance, in terms of algorithm trading, last 10 years, I would say that in the past 10 years, when they started, the market share of algorithm trading was pretty negligible. Today, algorithm trading accounted for approximately 50% of their total turnover on the exchange. And that actually is one example I want to show is how potential is a fintech and AI adoption in the trading space.
Thank you for that, Ken. So what you're sharing is that there's a lot of growth in AI and the use of algo trading. Maybe we can kind of dive into that a little bit later. Meanwhile, maybe we can have Sam to kind of give us a sense of what's going on in the equity crowdfunding space. Sam, you have the floor.
Thanks, Vincent. Well, for equity crowdfunding, 2020 has been a quite interesting year interesting year actually, despite the challenges afforded by the global pandemic. I think 2020 has seen a lot of improvement in this particular field, especially in terms of the deals we've done, in terms of the fundraising. All of the platforms, not just pitchIN, has done. But what has been interesting also, folks, is that for 2020, we've seen some changes in the regulatory framework for equity crowdfunding. The regulatory body has seen it fit to actually extend the amount of funding that companies can raise from a lifetime of 5 million to 10 million. There is now also an allowance for all platform operators to set up a secondary market, which we are at pitchIN pursuing. We've actually sent in our rule books and application for that, so we're hoping to get the approval soon. So 2020, to some degree, Vincent, is that despite we've seen the challenges outside there for other sectors, other verticals, but for where we are in terms of the fundraising and equity crowdfunding platform operators, we've seen a boom. Not just at pitchIN, but also across the board. We've seen other platforms raising more money than they did in 2019 and before that. So it's been quite positive. Again, I think throughout this particular discussion, I think we will probably dive into what we will see in 2021. Will we carry this momentum to the next year, or this is something of a reactionary year where we see investors coming in to invest in deals which they think are good because of the situation where these companies are and why they are fundraising. But yeah, in brief, 2020 to date has been quite good for the industry for equity crowdfunding.
I think one might wonder whether that's a design of the pandemic or whether it's the change in regulation which kind of allows for more of this, or even if it's the massive thing which helps with having more co-investment, right? So I think
That's right, yeah.
so many factors to look at. But good to hear that pitchIN is looking at the secondary market. I think that's what a lot of people are looking at as well. So why don't we quickly jump into coming from his viewpoint of what's happening within the P2P financing space. Coming, you have the floor.
To be here on a webinar with you again. Maybe if I can just do a 30-second introduction about our business model and P2P in general, is that we help to connect SMEs looking for access to financing, to expand, to grow the business, and so to bridge their cash flow needs. So we are that platform that sort of does the due diligence risk assessment. And once they pass the criteria that we have, then we put them available onto our website and mobile. And that's where investors are able to sort of view those investment opportunities and to start investing. So I think a lot of the platforms, not just in Malaysia but regionally, they enable investors anywhere from a retail up to an institution, and they can come in from a very small ticket amount. So, for example, our platform allows investment amounts from as low as 100 ringgit. So it gets things easy to start with and with small amounts. So generally, that's the business model that we operate. And we started off the business back in 2017 in Malaysia. So come next year, it'll be around 4 years. And we dispersed more than 500 million ringgit in Malaysia alone. So I think the problem statement that we wanted to solve when we started the company, not just in Malaysia, but regionally across Singapore, Indonesia, is that we saw that there was a gap in terms of having a very short-term, liquid, and low-cost investment opportunity for the masses. I think a lot of the sort of investment companies, banks, typically they have products that are more sort of bigger ticket, maybe for the more affluent segment. But the gap is really when you look at the retail and the mass market. So that's where we saw the opportunity. And when we launched in Malaysia, that was the similar hypothesis that we have as well. And I think from the last 3-4 years that we've been operating across the markets, I think Malaysians have basically shown a lot of very strong demand for this sort of like low cost, easy to invest, low investment amounts, easy to get started, transparent, keep it simple sort of products. I think that's and that sort of validates the hypothesis that we had. And I think even when you compare it relative to markets like, for example, Singapore, whereby we get a lot more traction here, given that it is less developed, right, from an investment landscape. So I think that is a sort of overall trend that we have seen since we started over a couple of years. I think one of the other things that we felt really drove the whole sort of adoption and the trajectory that we've had within the sort of investment landscape is that it was very tough to begin with when we started in 2017. No one really knew what we were doing. Was this legitimate and what have you? I think some of you might remember at that point in time, the whole JJPTR sort of money game was in the rage, right? So I think we had to fight against that to educate and build awareness. But I think of late then, when there is already some kind of momentum building, and then a lot of the investors that we get are through word of mouth referrals and whatnot, that really built the trust. And it's quite surprising to see how folks trust basically their sort of social network, right? When a friend refer them to invest through funding societies or any other platform, that really is a very effective channel that we saw and observed. I think the second trend that we saw is also when we launched our mobile app a couple of years back, and the ease in terms of how they can sign up fully digitally, able to invest, track their investments, ask questions, engage, make withdrawals and stuff like that, really helped to drive the engagement and adoption. And we see a lot of the investors that we have engaging with us through our mobile app more so than the website itself. I think that's the second trend that we saw in terms of how the sort of investment landscape for Malaysia from a P2P perspective. I think of late, obviously, 2020 is a bit of a weird year that Vincent was mentioning. In the second quarter, when the whole MCO and the whole COVID situation was in its first wave, there's a lot of uncertainty. I think that we do observe a bit of a pullback in terms of investment appetite, in terms of uncertainty, in terms of opportunities within the stock markets to start speculating in certain stock counters and what have you. So we saw a bit of hesitation in terms of people investing more amounts. On the other hand, also the whole sort of COVID situation meant that we went out there to provide a deferment program to support the SMEs because they're not allowed to operate and hence unable to make repayments because cash flows are at a standstill. So we provided the flexibility for a deferment program upon request to SMEs, and that also meant that investors wouldn't get repayments for a period of 3 months, but they did get additional interest amounts in the interim period. So we see a bit of, hence a bit of a slowdown in terms of continued follow-on investments. But after the whole 3-month deferment period was over, the principal amounts would then return back to investors, and then we can see momentum getting back up again. So I think in terms of volumes and what have you, I think we have sort of recovered almost very closely to pre-COVID levels. So I think that's a good sign. And I think the whole trend and the whole fundamentals around getting into a space that is easy and simple and low cost to invest is something that we do believe it's something to stay, and that will stay in the future.
Thank you for that. And I think according to stats that was recently provided by the Securities Commission, both the ECF and P2P have kind of helped SMEs to raise over 1 billion ringgit, right? So that's a pretty encouraging number to look at, which kind of shows traction within that space. So why don't we move on to Aaron? I think crypto is having a pretty interesting time, right? Bitcoin's just gone up to over 50K. So Aaron, why don't you give us some thoughts on trends within your particular vertical?
Awesome. Thanks, Vincent. So I just wanted to say that 2020 has been super interesting for us and crypto as a whole, because we saw that huge crash in prices in March when COVID first came around. So that was very interesting time, because I think everything you invested in, whether it's the stock market, the gold or the oil, or everything basically crashed in mid-March. So there was a lot of trading activity that happened around March. And then in recent times, there was a short period of time where the KLCI or the Kuala Lumpur stock market was super exciting to people. So we actually saw for a brief period of time that a lot of people were not trading crypto as much, and they were actually moving on to the equity markets. So it's quite interesting because, in for example, in overseas markets, they say, Bitcoin is getting more and more correlated with the stock market. Whereas for a moment of time, we saw in Malaysia that, or when the KLCI was booming, people were actually moving away from crypto for a while. So that was a pretty interesting time for us. But I think broadly speaking, 2020 has been, in my view at least, I guess you can call it a recognition of people getting comfortable with crypto or Bitcoin as an investment. Because when Bitcoin first came out, people were not sure, is this for cash? Is this to make payments? Is this for remittance? But I think overly clear in 2020 has been the sort of investment inflation hedge, or hedge against currency dropping, or hedge against volatility in other segments. So I think that has been the trend that we've seen in 2020. It's sort of the coming of age of Bitcoin as an investment class. And then, of course, in the past few weeks, or rather in the past few days, we've seen like huge moves in the Bitcoin price. So very, very interesting times. And PayPal yesterday announced they are going to allow Bitcoin purchases on their app. So very, very interesting.
Indeed. And I think that is also reflected in the fact that for crypto exchanges right now, with the 3 regulated ones, we have over 400,000 accounts open and is trading over 100 million, right? And that's just the ones that's trading on the regulated platforms. I know of many who don't use the regulated platforms. So the number is probably a bit larger than 100 million. But it is certainly an interesting time for all of us. For a moment, we look at the equities, gloves were the new crypto for a bit,
Really, it was like that. Like you can almost see an inverse correlation for that period of time. So super interesting.
Yeah, very, very fascinating. So I guess one thing that we can safely establish is that, the way that we invest, the way that we manage our wealth, the way that we plan for our retirement is quite different from our parents and our grandparents' generation, right? So maybe we can kind of explore what are some of those evolutions that we have seen over time, and perhaps what kind of different trends that we see happening overseas that we predict will kind of land in Malaysian shores very soon. So why don't we go back to Ken Yew to get some thoughts on this issue. Ken Yew, you have the floor.
Okay. In terms of, I would say from the client side, in terms of the customer experience, I think this new age style of investment or wealth management or even trading will definitely be technological driven. I think from account opening to transactional activities are done online. I think compared with previous days, definitely that is not the case. And also, I think over time, I think investment or financial advisors will be AI driven as well. With the adoption of the Fintech, I think I'm sure consumer can expect more products, maybe in multiple markets or even in different asset classes need to be offered. In terms of industry player point of view, of course, I think both Fintech and AI will definitely support their business needs. I think the low-hanging fruit would be the automating their business processes. Probably, I think through AI, they can gain insight, some big data analytics, and also I think engaging with the customer via the chatbot as well. So all this definitely will be very different compared with what we have seen easily 10 years ago.
I think that's very true, right? And of course, Kenanga, you guys have a partnership with the Rakuten Group to set up Rakuten Trade, which is an online brokerage firm. I think the stats was about over 200% increase in August, something like that. I'm not sure if those numbers are exactly accurate, but what it paints a picture is that people just want to get things done online these days. Nobody wants to physically show up to do anything anymore. Thanks for sharing your views, Ken Yew. So let's move on to Sam,
Sure.
and also later coming. And I think one thing that I wanted to understand, because right now ECF and P2P is still classified as alternative investments, right? So do we foresee like there will be a time where it's considered as a mainstream investment? So maybe we'll start with Sam.
Yeah, you know what, Vincent, good thing that you brought it up. And again, I've been thinking about this for quite some time. I think in the early days of equity crowdfunding, right, I was into that bandwagon that used the tagline or the brand alternative fundraising. But after some time, I tend to think, and again, I think all of us tend to think that by using that connotation, it means that we're the last resort, i.e., if you can't raise from anywhere else, then you go to the ECF guys to raise your funding, which actually gives it a very negative connotation in the end. And I think that's why I think as an ecosystem or as a vertical, we've probably moved away from that, from using that alternative fundraising. Because in the early days, I can tell you, Vincent and everyone, I myself was using that in my headline in terms of my presentation slides, right? ECF, alternative fundraising with pitchIN. And probably that was true for the first 2 years. I probably think that we've gotten mainstream in the last 1 or 2 years, especially this year, right? Especially when we've seen very good quality companies coming on board. The likes of Oxwhite, who was actually, and I won't name who they are, but they were being chased by a particular VC, but they decided to actually raise their funding on equity crowdfunding because they understood the beauty and the strength of what ECF can actually lend them, especially for a fast-growing consumer-facing product. And that's why they think, or they thought that ECF was probably the best platform for them, not as an alternative, but the platform that they need to go to. And I think we've seen that in the last few deals, we've seen not just technology-based companies, but also more traditional companies coming on board to raise their funding on pitchIN. I think it has to do with a lot of education and awareness that we put in. Having said that, I don't think we've actually covered the mass. There is still quite a number of sizable population in Malaysia that we need to reach out to. But I think I would probably debate anyone that will say that we are not, we're still the other way or the other option for people to raise money. I think slowly but surely we're becoming one of the first few things which founders and companies think of when they want to start fundraising for their growth.
Very quickly, Sam, before we move to Kaming,
Yeah.
from an investment viewpoint,
Mm.
rather than a fundraising viewpoint, because I
Right.
think it's still kind of described as alternative investment by some, right? So do
Yeah.
you see that as do you see ECF as already a mainstream investment, or is it still an alternative investment? And do you foresee a future where it becomes mainstream?
Well, I think right now we're still not reached that mainstream. So I would really be cautious about defining us as a mainstream platform where people come in and invest just like people do in the stock exchange. Yeah, we all know that it's still very much patient investing. If you invest right now, you probably need to tell yourself that you'll probably be there for the next 3 to 5 years, sometimes longer, right? But I think when the secondary market actually starts, and we're hopeful that we'll get the approvals very soon. Our target is that once we get the approvals, we actually want to launch it as early as the first quarter of next year. And I think that's where I think that particular education part can be sort of like addressed. Because right now, a lot of people, Vincent, when they talk to us, especially the older generation, yeah, the ones who are much more akin towards trading in the stock exchange. They don't understand why would someone want to invest in a company in the long term, yeah, because they don't see a path for them to actually get out anytime soon. And I think that's why the secondary market will be very important in terms of driving ECF to the next level. It will still be an education part for us, platforms to educate people on how the secondary market works. But I think give it time, just like we gave time for ECF, I think the secondary market could potentially be more active than what we see, what the lead market is actually offering investors right now. Especially when you see a lot of those investors in ECF are actually retail investors. So we're not there yet, but I think with the secondary market, I think there are clearly potential and signs that we could potentially be very much mainstream.
Okay, so you're saying you could potentially give the lead market a run for its money. Yeah?
Oh,
Very cool.
clearly, yeah.
Okay, so let's move on to Kaming to share his thoughts on this matter. Kaming, you have the floor.
Yeah, I think certainly that is the goal from both the SME perspective in terms of raising funding, as well as from an investor perspective in terms of investment platform. So I think the goal is definitely to be a mainstream digital financing and investment provider platform. I think that's certainly the goal. I think we have done well, relatively speaking, more so on the investor side than on the SME side because of the nature of it. So on the SME side, it's typically a B2B sales cycle. On the investor side, typically it's a B2C sales cycle. So the sales process are generally shorter on the investor side, and the sort of value proposition and what have you is a lot more standardized. SMEs are very different. They vary quite a fair bit, nature of business, cash flow cycles, risk assessment approaches, product natures, and stuff like that. So I think, and hence we have seen a lot more traction in terms of being much more widely adopted on the investor side. I think an interesting statistic is that the significant majority of investors on our platform are retail, and they are below the age of mid-30s. So they're generally the younger crowd, more the city metropolitan crowd. I think now having said that, I think we are still scratching the surface in terms of how much further we can go in terms of adoption as a mainstream digital investment platform rather than an alternative. And I think the regulators have done a great job in terms of a lot of the events that they do, for example, whether it's by the SC by SC conference or whether it's the SC InvestSmart events that they do on an annual basis. I think what we are trying to push for and hope to get more sort of visibility is at the sort of government or administration level, whereby then the push becomes a lot stronger, the awareness becomes a lot stronger, not just within the main city areas, within the sort of like younger investor profiles, but also more broad-based across the entire population and the geographical reach of what we do. So I think that's certainly the goal and some of the things that we're working on for us.
Very cool. And I think to your point that we are scratching the surface, I think it's also recognized by the regulators as well, which is why we see them giving license to so many players to actually be able to reach out to the market. What is it, like 20 odd players now, was it? In the
21, I think.
21, right.
21,
okay. Yeah, I think that's a recognition of that. Let's move on to Aaron on the crypto space. Aaron, go ahead. You have the floor.
Yeah. Cool. You mentioned earlier on in your question, you mentioned investing in our parents' time versus investing today, and I can't help but think back on those days. My mom is like super conservative, so she will invest in fixed deposits, and then when there's Amanah Saham new issuance, she will go line up at the PNB office or the post office. So that was investing 20, 30 years ago. And then my dad is a stock market trader himself, so he likes investing in the stock market. So I can remember him distinctly on the phone with his Remaisia, and then he'll like call me and then ask me, "Can you check the Teletext TV for the latest stock price?" So that was investing 25 years ago as well. And I think what we've seen, adding on to the points by Kaming, what we've seen today, the people investing in things like crypto are generally the younger people. And these are people who, if you ask them to fill in a form, they will look at you like, what? We have to actually fill in a form and sign a form? Because these guys are all used to investing in like automated KYC. They're used to scanning documents. They're used to sending things over WhatsApp. So these are the investors that we are seeing today. And I think, like it or not, things change, things get better. I think, even the government regulators are doing things like allowing non-face-to-face KYC. We see that happening with a couple of banks already. So I think this is just the way that things are going to go. It's going to continue to be very, very tech heavy. It's going to continue to be very innovative and very easy for the customer. And just circling back to my dad, like he's like such a big stock investor, but now today he's like probably a bigger Bitcoin bull than myself. So things continue to change, and yeah, we continue to evolve.
I think the clearest sign of user adoption is whether you can convince your parents to use it or not. So if your parents are using it, then I think you've achieved some degree of success over there. Okay, so before we move on to our next question, just want to remind the audience to feel free to ask questions. Whatever questions you have, we will try to incorporate into our conversation over here. So let's shift gear a little bit, right? This month is the financial awareness education month, right? So maybe let's talk a little bit more about financial literacy. A recent OECD report indicated that Malaysians score like among one of the lowest when it comes to knowledge in financial literacy. And around the world, we see a lot of fintech companies, startups trying to push for innovative solutions, ease of access, without necessarily educating the consumer about the risk of investing, right? So we had an unfortunate case where one of the young guys committed suicide because he misread something, which is a tragedy. So I guess my question is, are we as an industry doing enough to educate our customers? Or are we focused too much on new products, new innovations, and pushing this kind of investment to our consumers? So maybe we will start with Ken again, and then we'll go with Sam, Kaming, and then Aaron. Ken, you have the floor. Feel free to share your views.
Okay. Now, I definitely think that while there are a lot of new product being launched, but I think the industry player have been also, I think, doing a lot of, I would say, the CSR work, i.e. the training and the investing. I mean, this kind of investment seminar actually have been offered to the public investor. In order to enhance the financial literacy, definitely, I think investor education and awareness is one of the I would say the major factor in encouraging more investment participation. Even in Kenanga, we understand that that market needs, and as such, also we also I think have been organizing a lot of investment talks, seminars. I think some of them actually are educational, some of them are actually like market knowledge driven. To help the investors. In terms of way of trading, also we also I would say that introduce an alternative way of trading. For instance, like algorithm trading or systematic trading, to actually give investor another avenue. I would say the trading, and for those sophisticated ones that can have tools to help them to invest. Yes, I think also I think in terms of that I would say the educational awareness. I would say other factor also probably will determine the financial literacy. I think Vincent, you probably very I think point out very one interesting point is that if the parents actually I would say adopt this way, then the kids will actually follow. But that is one of the factors actually the influence the financial literacy. Like another, I think some of the research study also show that I think in terms of raising the financial literacy, I think the investor or the consumer themselves, I think they have to have the right attitude and the attitude to ready to accept the technology, and also to upscale and to retrain themselves. I think probably I think it's chicken and eggs, but yeah, I must admit that education is and awareness. I would say the major factors.
I think it's a good mix, right? Because at the end of the day, if we're dealing with retail investors, we cannot expect them to have the same level of sophistication as institutional or sophisticated investors. So while I think it's important for them to educate themselves, I think as an industry, we collectively need to be able to be a neutral voice to something like this as well. Sam, you have thoughts on this? Would you like to add on?
Yeah, thanks, Vincent. I think the major challenge for us actually in ECF in terms of growth is actually education. Yeah, I think it will be a hindrance to us if we don't have more people who are more educated and aware in terms of the products that we are offering. And I always fear that because it can only mean someone who may not understand by just following a herd, and suddenly potentially if that company actually then do not do well and they lose their money and they start what they call losing that trust in terms of what the platform is actually offering. So education is really paramount. It probably is probably one of the major challenges for us to grow more faster than we want it to be. Um, if now in terms of the role is responsibility, that's also another challenge. Companies like pitchIN, we're startups ourselves. Again, we take the role of educating it very seriously. But when you're juggling two things, um, competing against 9 other platforms, ensuring you got the best deals in town. But at the same time, you also want to educate people, those in the far other reaches of Malaysia. Those in the Klang Valley, they're probably more educated than some of our users elsewhere. And I think what we've not done well as an industry is actually to reach out to those corners of Malaysia, and I think that's where the most of the underserved population is in terms of education and awareness and financial literacy generally. I always have this feeling that while we in KL in Klang Valley talk about how cool it is with ECF, P2P, crypto and whatnot, I always ask myself and the team is that how can we grow when the market is not yet there in terms of understanding what we do. And I think it's also the same with everyone here in this particular what do you call session. That there is a lot of innovation happening everywhere, but in terms of the basic understanding, that's where I think there's a lot of lacking that needs to be filled. So I think any startups that are focusing on financial literacy is sexy, super sexy. I think there is a need for a lot of those kind of startups to be there to complement in terms of what we do as an industry, because clearly those in the industry, while they are still doing it, just like pitchIN is doing it in terms of going out there, educating, ensuring people know what they're doing. But I think there's a available cottage industry that's huge, that has huge potentials that is still lacking, where I think a lot of those startups should be focusing in. So yeah, while I'm happy with the fact that there is potential out there in terms of the market that's not being addressed yet, but I also fear that if these markets continue to be not educated, then it's going to be difficult for any one of us to grow as big or as fast as we want it to be.
I think that's also a design of a lot of these startups being concentrated in Klang Valley, that there's more penetration here as well, right? And certainly having the cross-district travel being kind of non-existent at the moment is a bit of a challenge to do more outreach in that part of Malaysia as well.
Yeah.
So you want to add something else?
Yeah, that's true, Vincent, because during the pre-COVID days, right, at pitchIN, we're known to have gone cross-country around Malaysia from major cities. So we're in our little bus or car driving from KL to Ipoh to Penang, even flying off to Kuching and KK, doing our thing, right? It was, a lot of time was spent But I think the level of education then was a bit more personal because you get to meet them one to one. They get to ask questions. It was more engaging. Virtual event is great, yeah, but sometimes you lose that engagement that you seek on a physical platform. So I think that's clearly, I think, while the reach can be better with virtual, but I think that engagement is not there. That's what we're missing. Yeah.
For sure, yeah, I agree that there's a place for it as well. So, moving along to Kaming, do you think we as an industry are doing enough to educate the consumers to be more financially literate? What else can we do? Kaming, you have the floor.
No, I think certainly very much aligned with the points that were made by Ken Yew and also by Sam. Fully aligned, whereby financial education and awareness is very important on this topic, especially for new sort of investment products with potentially different risk return characteristics, right? So obviously they cannot look at this the same way as they look at a fixed deposit instrument. So I think a lot of education and awareness and also sort of disclosures needs to happen. So fully aligned with both Sam and Ken Yew on that point. I think the perennial challenge is whereby this education and whatnot happens very well for the sort of online sectors of the economy. I think where it becomes a lot more challenging is on the offline component. And I think the whole COVID situation obviously is going to make it even tougher. So I think in some sense, we do our best. For example, we still do our regular webinars. We enhance our websites and whatnot, tutorials with information content, the kind of questions that we get very regularly from our investors. So we try to do our best on that. But I do think perhaps something it could be driven more from the administration or government level that will be a lot more broad-based than otherwise, than say an operator going to an individual and try to pitch and try to explain the services, which is going to be a lot more challenging because ultimately any kind of guidance or direction from a sort of independent authority that obviously becomes a lot stronger and more credible. I think, Vincent, if you don't mind, I perhaps want to sort of tackle the second part of your question earlier when it comes to product pushing, right? And are we spending so much time on developing new products as an industry and not too much on the sort of awareness and education part? I think generally there's two models that you can think of in terms of product development and pushing products. I think one is the Google model, whereby you try to iterate and test different propositions, and then if it works, then you invest more resources and time. And if it doesn't work, you kill that product, right? I think the other model is the Apple model, whereby they try to uncover latent demand. So they tell you need an iPad, but no one ever thought they actually ever need an iPad. So, but that's the general approach that they take. I think for us as an industry, generally we focus more on the formal approach, whereby we really listen to the feedback and the demands of the investors, our existing investors, as well as those that we meet in different webinars, events, conferences, and try to uncover the kind of investment characteristics or features that they want. So, for example, they would generally prefer shorter term financing amounts, what kind of interest rates, minimum interest rates that they'll be interested in, what kind of SMEs in certain sectors, and what have you. So generally, that's the approach that we take in terms of coming up with new investment products for the investors. I think the other point, now having said that, I think there's also a very important point around investor protection, whereby naturally when it comes to, say, the sort of financing business, generally higher returns correlate to higher risk and vice versa. And I think there is observations whereby if we don't put in the necessary safeguards and the tools to enable to help them to diversify the investments, then that's where investors might get impacted. And I think the unfortunate event that you brought up, right? So some miscommunication and what have you in terms of how they measure certain things led to death of a certain individual. So I think that's very unfortunate. I think for us, then the question is that what can we do on that note as a platform? So putting in place safeguards in terms of maximum investment limit so that you when you see a high interest rate return financing opportunity, you can't go all in, right? So we kept the investment amount. We roll out things like auto invest that allows people to invest from as low as 100 ringgit. So you don't have to sort of like, because of a lack of investment opportunities, you go heavy into a particular deal. And hence create concentration risk in your portfolio. So we try to have all these different mechanisms and tools and limits to help to protect the investors as well when they come onto the platforms as part of the investment journey. So I think there's a lot of things that's happening, and obviously we'll be open to feedback as we hear it from our own investors, existing or prospective. So I think that's how we'll sort of probably in the picture or the perspective from both education awareness as well as from a protection perspective.
Good to see that there are some mechanisms put in place. I think we as an industry have moral obligations on this kind of things. Let's move on to Aaron, and I think Aaron probably has a lot to add in this subject, given your work with Luno and your passion project with financial education, right? Aaron, you have the floor.
Yeah, thanks, Vincent. So I think firstly, I want to say that aligned with what Sam said is that we're all trying, and it's not easy sometimes to try and balance between trying to achieve profitability and also trying to do as much education as possible. It's not easy. We're trying. I think we can do more, and one particular area that I just want to point out is that it's not necessarily that pushing out new products and doing education and getting people aware of financial products, they're not necessarily like at odds with each other. It's not like necessarily one or the other, because I think a lot of research has shown that people learn best at the moment when they need to know the information. It's not like you go to a class and then you learn top 5 investments or how to protect yourself, and then you're gonna sit through that 5-hour class and then come out of that and then you're gonna be very good at investing. It doesn't work that way. Whereas people actually learn when they need the information at that moment. That's kind of contextual learning. So if you come up with a product that helps people learn as you help them to invest, I think that's the kind of gold standard that we should be aiming for.
Yep.
And there's multiple ways to do it. Some people have a demo account. So you log into an app and then you sort of learn to trade with maybe some fake kind of coins or something. So that's one way of doing it. There are other ways of doing it, like making the barrier to start very, very small so that you really, really limit the risk for the guy that you're learning. Because at the end of the day, I see it that without actually having a bit of skin in the game, your motivation to learn is not going to be very great. So even if you put in your first 10 ringgit into an investment, then you're going to start motivated to watch YouTube videos, to learn, to do a bit more reading and to monitor the price. But if you sort of try and take the education and limit it to traditional things like say, we must run webinar, we must run more online classes, then I think that it's not going to be as effective. So I think definitely we can do a lot more. And I would love to see that moving forward, we sort of leverage tech to do this kind of education stuff.
Some great perspectives over there. Thanks for
good
sharing your
point.
thoughts.
Can I just add on this?
Go ahead.
I think Aaron bringing a very interesting point. I think that is exactly what we want to do. In fact, I think early January, Kenanga actually have created a Telegram channel called Kenanga Trading, where we share the buy and sell signals through our in-house, I would say the trading system. We call it the volatility breakout system, whereby we can actually capture the upside of the volatility of any given stocks. So we will spell out very clearly what is the potential target, what would be the cut loss level, and very systematically. So for this system, always this is the kind of potential of return, and these are the potential risks you need to take. So once we actually created that channel, we try to actually educate investors via the real. So I would say the more real life kind of trading experience. So by sending those alerts and to share via this Telegram, I think it's a way of us to actually teach the public or the trader what Kenanga going to offer. And this is the potential, the way of investing going forward. You need to be very systematic. So that is a message we want to bring up and to actually send to our investor and consumer.
All right, thanks for that, Ken Yew. So while I still have you, I'd like to move on to some questions from the audience. So there's one particular question from Peter, who is probably a data geek over here. So his question is, has machine learning proven to be superior than traditional algorithms in the application of algorithmic trading?
Oh, this is a tough question. Now, to be frank, no research has been done on this, but definitely there has been a research done on the normal discretionary trading and the systematic trading.
Sorry, can you, before we carry on with that, maybe for those who may not be familiar with the terminologies, maybe you could explain it to some of the members of the audience between these two, and then maybe take Peter's question. Thanks, Ken Yew.
Okay. Now, the conventional or the discretionary trading means investor or fund managers will actually study the company in there and do their own analysis and decided this is the company or the stock they want to invest. So that is very discretionary. They use their own knowledge and gut feel to do it. Systematic trading, on the other hand, is very systematically driven. That means they will actually adopt a certain model or a certain technique. They will actually invest or buy and sell, follow that model. I would say very strictly. It means to say when this model give you a certain signal, it's a buy or sell, you have to follow strictly. So that approach compared with the discretionary, some research paper have been done, but no, there's no, I would say, the significant result saying that systematic trading is actually more superior compared to discretionary. No such thing, because over time, what they can say is systematic probably is more consistent, more scalable, whereas the discretionary trading, you have certain time you can make a very exceptional return, very big return, but probably you can only focus on very few stocks. So that probably are the differences. And machine learning, by right, to be frank, is a step further to bring the systematic a level higher. So once you have the systematic trading, because you are systematic, you follow exactly your rules. Your signals are actually, once you trigger, are based on certain conditions. And with that, then you can actually run machine learning on it, because your result, your input and the output is always consistent. So from there, you can do some further study to take out or to pay emphasis more on certain signals that actually have a greater potential based on certain, I would say, the factors, underlying condition or whatever. So that will actually increase your winning rate. That I would say that something can be done. But of course, discretionary also you can use the machine learning to I would say I would say.
Sorry, can you? I think we're losing you for a moment.
Okay, the keyword here is more on consistency. Yeah, so once you are consistent, machine learning can actually help you to improve the performance. I would say.
Cool, thank you. I hope you got that, Peter. There was a bit of a disruption with the connection, but I hope Ken Yew was able to answer your question. So let's move along to another question. We have a question for Aaron over here in team with consumer education. So Afiq is asking about cybersecurity and how we can keep our money safe from cyber attacks. Aaron, do you want to take this one?
Sure. So Afiq, you look very familiar in one of the recent talks. So anyway, I just wanted to say that the majority of cyber attacks, as I understand it today, and it actually comes in the form of, I would say, people or consumers not following best practices. So these are things like people having their they're using the same email and password. They're using the same password for multiple accounts. They're not securing their accounts with two-factor authentication. They are saving their passwords in plain text on their handphones, on their laptops, or worse, on the cloud. So I think all these sort of best practices will probably keep you safe in most of the scenarios. Really, those scenarios where you hear of people like a super sophisticated hacker from Russia like cracking in and then doing stuff like that. I think for most people, you don't need to worry too much about that because it's kind of out of your control. So worry about the best practices that you can control, which is things like, again, securing your passwords, doing the 2FA, things like that. Specifically on your point about hardware wallets and cryptocurrency, again, if you're a sophisticated investor and you have big holdings, I would say that's not a bad idea. But yeah, again, a hardware wallet itself might cost you, say, between 3 to 500 ringgit. So if you have to size it based on the amount of investments you're trying to protect. So for example, if you have 300 ringgit in crypto assets, you probably don't want to buy a 300 ringgit wallet to save it. So yeah, but maybe if you have 1 million, then that would make sense. Hopefully that answers the question.
And as in all things in life, everything has to be proportionate, right?
Yep.
So we have a question here from Liu Yuliang for Kaming. So this person over here is asking about default rate. Maybe Kaming, you can address whether it's true that there's a lot of defaulters, and if it is, why is there so many?
Yeah. So I think thanks a lot for the question, Yuklong. So I think maybe just to set some context, that any kind of financing or lending business, there are risks involved. So shouldn't assume that there is no defaults. And I think on the topic, then the question becomes, what is the extent of it? So I think for us in Malaysia, our default rate is hovering around 3.1, 3.2% in terms of default rate for Malaysia specifically. And this is based on very standardized definition that the SC has required us to report our default rates on. So, and they're all aligned across all different platforms in Malaysia. So that's our default rate. And then to basically set some context behind how this number compares to other sort of similar loans that have been provided by banks. So for banks, if you look at unsecured financing for SMEs, typically they would range in terms of default rate in the high single digits. So I think we are outperforming in terms of default rate for the SME sector that we serve. Also understanding that the SMEs that we serve are generally smaller than the SMEs that banks will be serving. So I think that hopefully puts a bit more context behind the default and also the default rate performance. I think to date, we have served 2,000 SMEs to date. So I think that probably from an absolute number perspective, it would tend to keep going up over time just because the size of the base is bigger. Now, having said that, from an investor perspective, what should you do then? I think from an investor perspective is that to make sure that the investment portfolio that you have is well diversified. And one of the key reasons why we have done it in such a way that investors can invest from as low as 100 ringgit in every single SMEs. So I think then for situations whereby most of the situations whereby we see investors are being impacted significantly by defaults is when they have sort of concentrated portfolios. So they could invest, say, a substantially higher, proportionally higher amount in a lower interest rate SME or a much higher interest rate SME. So, and when for whatever reason the SME defaults because of failure in the business, COVID, etc., I think that's where the concentrated exposure actually impacts the overall performance of the portfolio. So I think that's something to keep in mind, and also perhaps something to explore in terms of, if you're not already, in terms of using the sort of auto invest feature that we have on the platform. So that allows an investor to easily invest into as many deals as possible at a low amount, and then protect against any particular default by any particular SME. So I think that's probably how I would sort of try to clarify. I think in terms of the COVID situation, I think the good what we have observed is also we have made changes in terms of the sort of credit policies and the financing structures in light of the current scenario. So, for example, being a bit more particular around the industries that we're serving, and also in terms of the exposure limits that we provide, particular SME. So last time it could be, say, ringgit 1 million, but now we have cut it down back to 500,000 ringgit. Now, having said that, obviously now the balance is to make sure that we try to balance between the needs of SMEs as well as the need of investors as well. So I think that's how generally we try to play the sort of the middleman in terms of balancing the needs of these two parties. Hopefully that clarifies, Yuk.
All right, thank you for taking that, Kaming. So we've unfortunately ran out of time, but let's close off with two last questions over here before we wrap up the session. So I think one thing that when we think about investing in wealth is for the purposes of retirement, right? That's a lot of reason why a lot of people are investing, other than college funds and whatnot. But then ultimately we want to be able to retire comfortably. But over 41% of Malaysians rely on their EPF as a main source of retirement. Many of them are not even able to reach that basic savings recommendation by EPF of 240,000. So the first question is, what can the industry do more to get more Malaysians investing? And the second question is, what are your predictions for the market next year? So maybe we'll start with Sam, Kaming, Ken Yew, and then close off with Aaron. Sam, you have the floor.
Sure. Right. So, Vincent, on your first part, right? I suppose if we're talking about where the market where we are playing in ECF, I think in terms of how do we get more people to come in, is actually getting more information out there. I think there's a lack of information out there that has been shared that will allow some of these investors to come in and look at some of the companies that we're actually helping to fundraise. So the information part is always very, very important, and we stress that to every company that comes on board the platform, that the more information you share, the more transparent you are, I think the more receptive people could be in terms of investing in your company. So I think we probably need to show also some ways for companies or investors to exit. I think as everyone knows, people do not invest for the sake of charity. Everyone wants to see an ROI in their investment. I think the challenge for equity crowdfunding, especially with helping growth stage companies to raise money, is when is that particular exit happening? We hope the secondary market will be that platform to push people towards looking at ECF as a credible source of investment for them. So there are things being worked out right now that we hope will later be that catalyst for people to come in and invest in some of these very, very good potential companies that we see on ECF platforms. Now, in terms of what I predict or what I would like to see in 2021, I think potentially there is a potential for some mergers and acquisitions, Vincent, in this space. I think we seriously need to look at that if we really want to seriously become not just a big player in Malaysia, but also regionally. So I expect to see some, if not happening, at least some discussions being done. And apart from all those new things that are coming in, because we will see that every year, right? But I think next year is probably the year that we probably see a lot of those serious discussions on some mergers and acquisitions. Yeah, so that's what I'm expecting for next year.
I'll be talking to you on the sidelines about who you're looking at acquiring. All right, now let's move on to Kaming for your closing thoughts on how we can get more Malaysian investing and what are your predictions for 2021?
Yeah, I think, just to close things up, I think the key is really to keep things simple and to make it easy. And make it as transparent as possible in order to sort of reach out to and educate investors. So having a fully online process, one that is as short as possible, being very transparent about things like how does this work. I think that is basically, and keeping the whole commitment small, right? So it's like no commitment, limited fees if no fees. I think that is really the key towards getting things started. So I think to what Aaron was mentioning earlier, it's not about how much, you can start preaching, we can start talking about it, we can start educating, and we continue to do that. But I think it's lowering the barriers to get started. I think that's probably the key that the industry could do in terms of making it simpler to onboard, easier to invest, and so on and so forth. I think that's probably the key. I think if the sort of barrier to entry or the hassle in terms of learning or getting started is just too high, I think then probably the level of engagement or even the attractiveness of it, you have to overcome sort of like some of the more common traditional asset classes, right? Stocks, bonds, unit trusts, and what have you. So I think that's on the awareness and adoption side. I think the point around 2021, I think 2021 would very much depend on how volatile the conditions become. I think for 2020, obviously has been very volatile in terms of like, we know there is a hole, we know things are not good. But the thing is that no one knows how big the hole is and how long it will last. But I think having gone through this year, I think folks have a better sense in terms of what the steady state could be. So I'm not saying that maybe 2021 will be a great year, but at least 2021 will be more certain than 2020 was. And with greater certainty, notwithstanding may not be a great year or could be a great year, people would have a better sense of how they want to sort of position their investment strategy. Yep. And folks will be a bit more comfortable in terms of, exploring new areas because they now know the lay of the land. I think that's really what I'm looking forward to 2021. I think there's been a number of new operators, whether it's ECF or P2P, that was announced late last year sort of time period. And I think the whole COVID situation obviously put things on hold, right? And I do expect for next year for more players to be more active, going out there, scaling the businesses, building more awareness. So I think that's what I expect for 2021. But I also do think, to Sam's point, perhaps some consolidation in the markets and what have you, because ultimately it's a business that requires scale in order to be sustainable. So I think that's very important as well to look out for.
All right, thank you for that, Meng. So let's move on to Ken Yew to get his thoughts on what we can do to get more Malaysians investing and predictions for 2021.
Okay, I think definitely, I think Malaysia is one of the high saving rate nations. So we have no doubt about the ability and the capacity of Malaysians to invest. But in order to entice the higher investment activities, I think industry player could probably offer more investment products, not homogeneous product. I must say it have to be in multiple markets and different asset classes. Because if you look at the what's actually offered in town, limit for the conventional investment vehicle now, mainly in the FD, unit trust, property, equity. Some probably the physical gold, or I think crypto is the new one. So the reason why we need different classes of product is very simple, because then you can make diversification easier. Otherwise, if you just offer very homogeneous kind of product, your I would say the risk reward profile are pretty much similar, and therefore actually making diversification pretty hard. And of course, I think talk about the more product, definitely have to talk about educational stuff. Talk about investor awareness as well. So more activities from there. Just now I will share about the Telegram channel we have, and of course I think in the near future also Kenanga also want to promote more systematic trading. The reason being because systematic trading to us, I think, is one of the efficient way for investor to pick up and also to trade the market to enhance their winning rate. And once you have that, they are familiar, then only we can talk about other more sophisticated products like algo, like AI trading kind of stuff. So, but before that, your foundation have to be right at the first place. In 2021, I would say that still, I would say mostly I think for Kenanga side is mainly more on the educational, more on the systematic trading, and also I think I would say they start create some awareness on the algorithm trading as well. So this is a very immediate plan we have.
All right, thank you for that. Now let's move on to Aaron to share his thoughts on how we can get more Malaysians to invest and what he predicts for 2021, whether Bitcoin will moon or not. All right, Aaron, you have the floor.
Yeah, thanks, Vincent. I think what I hope to see in moving forward on how we can get more people investing is more collaboration between the industry players themselves. So there were a couple of good plans which I heard of like late 2019, but I think when COVID came around, it just wiped this away, right? I think there were things like we were thinking of doing InvestSmart in different cities around Malaysia, InvestSmart in Borneo. So I think these were actually very good initiatives driven by the government regulators themselves. And I would love to see more of these kind of initiatives instead of sort of us trying to compete for attention amongst each other, especially in just the areas of education and awareness on investing. I would hope that we could collaborate a lot more. So yeah, Sam, if you want to go on your trip around Malaysia, please invite us and we'll come along or something. 2021 predictions, I am going to say a self-serving one. I think that a large traditional financial institution in Malaysia, I predict it's probably going to allow investment into Bitcoin and crypto. So I really think that's going to happen. Looking at trends around the world, yeah.
Is that a prediction or is that a hint to Ken Yew?
Yeah.
With that, only leaves me the great pleasure to thank all of you gentlemen for joining us today. Before we go, just wanted to quickly show some message of appreciation from the audience. Some of the people really enjoyed the session over here. I'm glad you guys were able to join us to listen to our panelists, and I'm thankful to the panelists for sharing their views. We hope you have a great day ahead. Stay tuned for future episodes and do subscribe to our YouTube channel at Fintech Fireside Asia for more content like this. All right, take care, everybody. Goodbye now.
Bye.
Bye.